Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is a gold fund manager at Equity Management Associates. He also invests and covers Bitcoin. Lawrence Lepard, thank you for joining me again.
Hey, thanks, Jason. Great to be back talking to you again.
So, Lawrence, I want to ask you for your opinion. We're recording this interview, by the way, on Thursday, March 23rd, 2023. I want to get your opinion on the small and regional banks, bank runs with Silicon Valley Bank, Signature Bank, because you're in the Boston, Massachusetts area, and you were posting on your Twitter about a bank run at the Signature Bank, right?
That was actually the Silicon Valley Bank. I had a photo. Yeah, you're right. I live in the Boston area. I'm actually not there right now. I spend the winter months in Florida, so that's where I'm recording from. And that I didn't actually take that photo myself. One of my good friends took it and forwarded it to me, and so I posted it. But that photo of a line of mostly boomers outside of Silicon Valley Bank in Wellesley was, to me, it was kind of reflective of the 30s, and I said, shades of the 1930s, right? People lining up at the bank. So to your overall point, as we all know, Silicon Valley Bank made a big mistake by using all their excess deposits, which were created by ZIRP and the misbehavior of the Fed. I mean, they ended up with a lot of deposits because money was free and everyone was just kind of shoving money at them, and there were lots of sources for venture capital, and that was their big client base. And so they needed to do something with those deposits, and they decided the smartest thing to do was to buy government mortgage securities, which are guaranteed and therefore very credit-wise not at all risky. They're kind of super credits, but unfortunately what they did is they bought long duration. So they bought, I don't know what the average was on what they had, but certainly a lot of it was between 5 and 15 years, perhaps some even longer. And I remember in my write-up I'm doing for my quarterly, I noticed and did some research. I noticed some of the stuff was as low as 1.6%. So, and that's because the 10-year was down at that area when they were writing those mortgages. And so, what happens obviously is that rates go up to, the 10-year went up to 4, and all the other shorter rates went up even higher. And, people at these banks aren't stupid. If they've got things on deposit and they can earn 5% in the treasury bill, they might pull their deposit out. Well, that started to happen. And of course, as it happened, then they had to sell some of these securities at a loss. And then the disclosure that they were selling securities at a loss got the market to thinking, oh my God, we got a real problem here. And everyone quickly did the math and realized that the bank had negative equity. And so obviously then you had a run on the bank. I think it was on March 9th, Thursday, March 9th, $42 billion was requested in withdrawals. And that left the bank with negative 958K or something of cash. So the next day the FDIC took it over. And this problem, I mean, Silicon Valley is probably the biggest. It's the poster boy and the biggest and the most obvious example of this. But I posted up on Twitter, and others have as well. There's these securities that are undervalued or that are not valued at market at what they paid for them are called held to maturity securities. And this is throughout the banking system. Other banks have the same problem to varying degrees. There are and are rumored to be other banks that are going to run into the same issue. I mean, the most notable one, of course, is First Republic, which the Fed and the Treasury went to the major money center banks in the United States and leaned on them and said, you're going to put $30 billion in deposits in First Republic to back it up, since you're getting tons and tons of deposits from the Silicon Valley Bank and other customers. And the issue there, Jason, as I'm sure you're aware, and most of your listeners probably were too, is that while the Fed and the Treasury did bail out Silicon Valley because they determined it was systematically important, and a majority of the Fed governors voted for it. The Treasury approved it, and the president actually approved it. And that this was a systematically important bank that if it failed could lead to the contagion could spread. But they did not bail out all the other banks. And so, to clarify kind of the whole issue here, large banks in the United States are called GSIBs. Globally significant investment banks, I think it stands for, and they have an implicit government guarantee. I mean, they're
big to fail, yeah.
They're too big to fail, right? And so the most obvious ones in that bucket are, J.P. Morgan, Bank of America, Wells Fargo. There are others, but
Citigroup,
yeah. And so, Silicon Valley was just below that category. I think the cutoff for GSIB is 250 billion of assets, and Silicon Valley was like 211. And actually, they actively tried to avoid becoming a GSIB, because if they had, they would have been more regulated and under more scrutiny. And so, this is the first non-GSIB bank to fail. It's the second biggest bank fail in the history of the United States. At the time of its failure, it was the 16th biggest bank in the country. And so now the issue is, there's contagion, right? There are all these regional banks. I mean, Zero Hedge had a good article that said regional banks kind of account for 60% of the business activity in the United States. I mean, JP Morgan doesn't want to bank the local, dry cleaner or the local car dealer. A regional bank does that. And yet all the regional bank depositors are only insured up to 250,000, and nobody knows what's on their balance sheets. And so what we're seeing now is what I consider to be kind of a banking liquidity crisis, where, if you're a corporate treasurer and you've got more than 250 in a bank, you're almost being irresponsible if you don't take some out and put it in another bank, or take some out and put it in treasury bills.
And there's also been a big run to money market funds. I think about 1.4 trillion has left the small and regional banks in the bank accounts and savings accounts and gone into money market funds too, or to larger banks. Yeah.
Well, that's right. And so what the Fed has effectively done is it's made all these smaller banks riskier. And then, of course, they flip-flop. Janet Yellen said, well, maybe we'll guarantee all the deposits in the United States. And that's an interesting claim, because there's $17.6 billion of bank deposits in the United States.
Trillion, yeah, not trillion.
I'm sorry, I meant to say trillion, yeah. And there are only about 128 billion of capital in the FDIC insurance fund. So,
yeah, we were joking before we started recording how underfunded the FDIC is.
Yeah, exactly. And so, and the Fed balance sheet's only 8.4 trillion. So, what is the Fed balance sheet? I mean, obviously not all 17 trillion of the deposits or of the deposits are at risk, but some piece of them are. I mean, I've seen estimates of maybe a trillion, maybe two are at risk. So the Fed just going to kind of tack that onto their balance sheet, and then they created this interesting program, this BTFP program, which wags have called buy the fucking paper. The bank liquidity program, where they would swap out these bad assets and give you 100 cents on the dollar if you're holding some of this bad stuff, arguably for a year. But after a year, they're probably not going to get cured within a year. So then they're going to extend it. And the statement was they were only going to do it with assets that were on the balance sheet before March 12th. And of course, in fact, it's going to get stretched. That they could change that rule too. So the bottom line is, to some degree, the Fed and Treasury are backstopping the entire U.S. banking industry. And
the rules keep changing. And then we saw the currency swap line press release. So it looks like they're going to be backstopping the rest of the G7 banks. So potentially Canadian banks. I mean, the main issue right now, at least, is Credit Suisse. I've known that for over 12 months. I was told by hedge fund contacts 18 months ago that they had lots of loans the size of Archegos, 30 billion out, and that eventually the Credit Suisse was going to be a big problem. The mainstream financial media left it out. And then yesterday, on Wednesday, Lawrence, the Fed won't even allow any questions from the mainstream financial media. I'm sure they were issued stern warnings to not bring it up, anything. No one's allowed to say anything about the currency swap line press release that the Fed gave out, a couple days ago.
Yeah, no, I mean, it's amazing. I mean, some woman asked a pretty tough question of Powell in the press conference after this meeting. She'll never be invited back to one of those. But I was shocked. I mean, to me, the Fed is making unforced errors. I mean, on Sunday night, so the dollar wasn't ripping. There was no sense that there was systematic stress above and beyond, Credit Suisse, which the Swiss government had dealt with. And yet the Fed and the Treasury felt compelled on Sunday night to announce that they were opening unlimited swap lines. And not only that, it was the Fed, the Treasury, and every other central bank in the world made a joint announcement that they were opening unlimited swap lines, in order to provide liquidity as needed. So they obviously saw and thought that there was a real risk.
I think the real risk, Lawrence, we were discussing this before we started recording. It was hidden in one of the disclosures that UBS announced, is that the Swiss government and the Swiss central bank have written contract guarantees guaranteeing losses for UBS to buy Credit Suisse on all of Credit Suisse's interest rate derivatives. And we don't know the real number that they have, because these banks have gotten away with not being accurate with their total derivatives exposure. So they could have hundreds, tens of billions, hundreds of billions, maybe even $1 trillion worth of interest rate swap derivative exposure.
I think that's exactly right. I mean, you're talking about the elephant in the room, which is, Silicon Valley Bank didn't get brought down by derivatives. It got brought down by just poor risk management and interest rate risk. But when you get up to the GSIBs, they've got all kinds of interlocking transactions, back and forth. And, basically if a GSIB goes down, the whole system is going down. I mean, that's what we saw in 2008. And, from 2008 to today, all we've done is grown bigger with more leverage and more derivatives. So,
and more bailout, more hidden bailouts, more currency swap lines. I'm wondering the over under on how many secret bailouts Deutsche Bank has been bailed out since 2008. Maybe it's 3, 4, or 5 times over that 15 years.
I've long maintained the Fed and the Treasury maintain two sets of books. I mean, they generally speaking try to disclose everything they're doing, but the Exchange Stabilization Fund under Mnuchin grew from a couple $100 billion to $800 billion at one point. So they've got a lot of cash they can throw around. And as you and I discussed before we started here, when they have a problem like the 2019 repo blowout, Ken Griffin at Citadel was, he was definitely going to go tits up on his risk parity trade. And yet the fact that he pays Bernanke a lot to be an advisor, I'm sure greased the skids for, the Fed to provide him with swap lines to prevent him from blowing up. And that, that's just part of the kind of the corruption and the broken system that we're dealing with. And that's why sound money is so essential to fixing this corruption, fixing this broken system. I mean, these people who can borrow for 0% and gamble with the public's money, and it's heads they win and tails we all lose, because if they lose, we have to bail them out. That's just wrong. It's broken.
Oh, yeah, I totally agree. And we have the large banks right now. And what you said, they put 30 billion into First Republic, but basically the banks can earn higher interest rates, putting that capital into there. And the Fed is going to subsidize the large banks, which are the Fed shareholders, the owners of the Fed. So your Citigroups, Absolutely. Your Bank of Americas, your JP Morgan Chases, they're going to get to pick and choose whatever assets they want out of the small and regional banks, because I think there's a lot more pain coming for the small and regional banks over the next 6, 12, 18, 24 months.
Absolutely. And, the Fed is losing a lot of money. I mean, they used to remit money back to the Treasury because they were earning more on their assets than they were, paying out in interest. Of course, now that's flip-flopped and it's gone very deeply negative. And, they call it a deferred asset, which is kind of a joke. But, the fact of the matter is the Fed, and I read today that the Fed might have as much as a $1 trillion mark-to-market loss on their portfolio of bonds. And so, now the Fed can't go bankrupt because it's really the government and they've got the printer and they can kind of print it for themselves. So, But the point is that the whole thing is just incredibly upside down. And I think it points to an issue that those of us who are in the sound money community have been saying for a long time. And Max Kaiser really says you can't taper this Ponzi, and they just can't reduce the growth of the money supply and expect that the financial system is going to hold together. There's just too much debt. There are too many obligations, too many things that have to be paid. And if you don't have a growing money supply, something's going to break, something's going to fail, things will fail. And then the failures will cascade because they're also interlinked. So
totally agree.
To me, this is not, this is not a blatant pivot, but it's a soft pivot. And, I think that it's very interesting to me to watch the price of gold, which just today finally got over 2,000 briefly, didn't stay there. But look at
the Fed's creating even more distortions, Lawrence, because the Fed is still talking about wanting to raise interest rates more. They just raised interest rates another quarter point. They could still conceivably keep raising interest rates while they secretly do these bank bailouts, creating even more distortion. So we could see a lot more.
Yeah, and they're chasing their own tail, because the additional interest rate rise are only going to make the debt problem worse. They're only going to make the interest problem worse. But you're right. They know they need to maintain higher interest rates in order to try to slay the inflation monster. So they're going to do that. But over on the other side of the table, they're handing out money left and right. And
they're going to bankrupt. They're going to bankrupt.
I thought it was very interesting that if you looked at, I'm sure you saw it last week, their balance sheet went up by $297 billion. I mean, they erased from the time when they started tapering in early 2022 in February till now, they had managed to taper, I think, close to $600-700 billion of their balance sheet. They were doing QT, quantitative tightening. They just gave back half of that, approximately half of that. So,
and that's only the official number. We have no idea what the Fed is actually doing with the currency swap lines to the
that's right.
National Bank and the European Central Bank for the bank bailouts there. I mean, if they're going to guarantee those interest rate swap derivative losses, I don't even think the Swiss government, I don't even think the Swiss National Bank can afford to cover those losses from Credit Suisse if they have hundreds of billions or trillions of dollars in interest rate swap losses.
I think that's exactly right. And it's a real problem. I mean, it's, the other thing you saw that I thought was very interesting was that the Fed discount window, which almost never gets used, shot up to $153 billion last week. And, that was a bigger number than the peak that it reached in 2008. Now the economy is bigger, and so it's not apples to apples. But the point is that there was a lot of financial stress in the bond market and in the money markets in the past 2 weeks as a result of the crash of Silicon Valley and Credit Suisse. I mean, if you look at, there's some bond volatility indices, and I'm actually writing about all this right now. It'll be in my first quarter report, which will be out in mid-April. It's free. I'll put it up on the net. The bond market became extremely dysfunctional in the last couple of weeks, and they're trying to get it all back under control. And it's possible they have, but it's also possible they haven't. They for a while they were talking about maybe guaranteeing all bank deposits because they were seeing such an outflow, but then she backed off of that in the last couple of days. So we'll see.
Well, here's the thing, Lawrence. If they keep interest rates at these levels, or they keep raising interest rates, the Main Street economy, so small businesses, regional banks, a lot of companies, a lot of different industries, they're looking at much higher interest payments on debt, on corporate balance sheets. And then I think, unfortunately, over the next 12, 18, 24 months, I think we're looking at a very large commercial real estate bust here in the United States. And these commercial banks, I was interviewing Ted Oakley a couple of days ago. He said some of these small and regional banks have 60-70% of their loan book is tied to commercial real estate. Yeah,
you bring up a really good point that I hadn't touched on at all. And that is that, what we're seeing right now is just as it relates to these longer bonds, long duration bonds. But, the Fed's ZIRP policy basically led to massive malinvestments everywhere. And people were reaching for yield, and then they were doing the risk parity trade, which is they were levering whatever yield they could get to try and make the yield even higher. And it was all built on the assumption that the cost of money would stay low. And so, yes, you had buildings that were built because they had low interest rates, and why not? And of course, COVID comes along, Zoom comes along. I read recently that, office vacancy in Manhattan might be close to 50%. And so the commercial real estate industry is not exactly a shining star of good economics right now. And somebody made those loans. And, they made longer, sometimes 10-year loans, sometimes longer, but mostly 10-year loans at some fixed rate, of 2 or 3% or lower that, today would not be appropriate for the risk assumed. And so those loans are impaired, and somebody's going to eat those losses. They just haven't showed up yet, as you point out.
Well, we're seeing, but they will. We're seeing the red flags now. We're not seeing the bankruptcies yet. So we're seeing these real estate investment trusts, Lawrence, and the dividend cuts are across the board. So red flags
that's
there.
A really good one. Yeah, two big red flags. When Starwood and another big one, I think it was either BlackRock. I get them confused. It was BlackRock or the other
Blackstone.
Okay. Yeah, when they gated their withdrawals, I mean, you knew, something's going on here, right? These guys can't make they don't have the liquidity to pay out people who want to get out of the investment. That's not a good sign.
Yeah, so we haven't had the failures yet, but the red flags are mounting, especially with the dividend cuts for the real estate investment trust, because these companies said only a couple of months ago there wouldn't be dividend cuts. So now there are. So clearly they've been lying.
Yeah. But again, the bigger picture, Jason, as you well know, is that malinvestments were made. And the assumption was people bought long duration assets at too cheap a yield. And when short term, and they did it with short term money, because in ZIRP, money was free, and even the T-bills and T-bonds were relatively cheap, and so they could access capital cheaply, turn around and get a 3% yield, and that felt pretty good, for a bunch of years, and then they could lever it up so it became even higher. I mean, this is the LDI stuff in Britain was the same story, right? I mean, these pension funds, they were trying to juice their yields by using leverage to buy more 2 or 3% paper, and if they levered it 3x, 2% paper yields you 6%, right? Yep. The problem is the cost of borrowing the money to lever it to 2 or 3x. When it's zero, that's fine, but suddenly when it becomes 4 or 5%, guess what? You're bankrupt. So that's kind of the story. Short-term funding matched by long-term assets that had a fixed yield that did not move up. I mean, all of these people should have been hedging their interest rate risk. Some of them did, but most of them did not. And so that's going to be an enormous problem for a ton of financial institutions. There are a lot of losses out there that will need to be taken. by financial institutions, and they have not been taken yet.
Oh,
and
I agree.
So,
and there's a lot of US pension funds that haven't marked to market any losses because the capital that they gave to either the private equity funds or the hedge funds or some of these other funds, they're still reporting profits on the investments.
Yeah, I saw that. There's like $12 billion in private equity and venture capital. And I'm telling you, the marks there are probably very fictitious. I mean, and when the write-downs start to happen, it's going to happen fast. And then, you're going to see some of these markets are going to no bid for some of these assets.
Oh, and the Fed will be the buyer of last resort at what,
that's exactly
par
right.
or 100 cents on the dollar.
No, that's exactly right. And so in order to prevent an outright, bust and collapse of a lot of these big institutions, who is at the end of the day, where's your backstop? It's the Fed. I mean, at the end of the day, and they're driving consolidation into these bigger banks. I mean, you can end up with two banks in this country, the Fed and JP Morgan, because everybody else, doesn't have access to capital, and nobody trusts anybody unless they're a GSIB. And even within the GSIB community, everyone figures Morgan's the safest because it's the biggest, and the Fed, it's really kind of the Fed's bank, and everyone knows that. But the bigger problem, I mean, the bigger related problem is that as all of these issues surface, more and more people are aware that the Fed is a naked emperor, and therefore they come to the conclusion that they have to and will continue to keep printing. And so this is an area that I've done a lot of work on, a lot of study over the years. And high inflations and hyperinflations occur as a result of a large group of the people involved in the economy coming to the conclusion that the Fed, that the money printing authority, in this case the Fed, can never stop. And once it becomes obvious that mathematically they're trapped and they can never stop printing, or else the system will collapse, and everyone knows that politically having the system collapse is worse than inflation, they will print, and therefore they will have inflation. And that's why we make the bets we make, on gold, silver mining stocks, and Bitcoin.
Do you think that's all? Do you think this risk that people are seeing, because if you're a foreign government and you're a large country and you're running a trade surplus right now, you could earn a 4 or 5% just recycling your trade surpluses, your foreign exchange reserves back into the US Treasuries. But that's not what's happening, Lawrence. You're seeing Singapore, you're seeing the People's Bank of China, you're seeing a lot of non-G7 countries and central banks. They're large net purchasers of physical gold tonnage lately.
That's exactly right. And you're right. You could earn that on a nominal basis. You could earn that face amount of money. The issue is, what's the dollar going to do? And as we all know, since last September, October, the dollar is down very substantially. I mean, I believe it was 115. It's down to 102 and slipping. And so, yes, as more and more people come to understand that the Fed is trapped, they're not going to believe that, yeah, great, I can get my 5%, but if the dollar depreciates 5%, you're not getting anywhere, are you? And in turn, they may look around and say, hey, you know what? They can't print gold, and gold is performing. I mean, look at financial assets last year in 2022, gold was actually one of the best performing financial assets in the entire year. I mean, it wasn't up a lot, but everything else was down 20%. I mean, I'm averaging out, right? And so, as that becomes more and more evident, as you just pointed out, the central banks bought a record amount of gold in 2022. And I believe that will accelerate and continue because it's a neutral reserve asset that cannot be printed. And, you've also got, as the BRICS countries and, China, Russia, and others, and the Saudis all kind of saying, why should we be selling our valuable natural resources for currencies that are programmed to debase, like the euro and the dollar? And I mean, they've literally come right out and said that very, very clearly. And so, you can kind of see the way the wind is blowing here. It's pretty clear.
Yeah, I mean, the Saudis, they should have just bought a lot more physical gold. They put, $1 trillion or something like that. They put like many billions, I think, into Credit Suisse, and they lost 93% of it in a couple of weeks.
Right. Well, yeah, that was a way back when they made it. I mean, part of what triggered Credit Suisse, as I understand it, is that there was either a requirement or a discussion of maybe another round of financing, and the Saudis said no. And so that was what kind of caused the Credit Suisse ball to get rolling. I mean, and look, all these things are a confidence game. I mean, you could see with Credit Suisse, you knew it was going to happen. Greg Foss was calling it out on Twitter. I mean, all you had to do was look at the CDS, and it looks like a hockey stick kind of going parabolic. And so, the CDS is obviously the insurance cost of potential Credit Suisse failure. And, it told you that there was people were worried about that bank. I mean, there are others in the United States that are at risk. I mean, I heard some stuff today that said, and if you go look at the numbers on it, it doesn't surprise me. It seems possible that, a big firm like Charles Schwab might be in trouble. I mean, if you look at their balance sheet, they have a lot of held to market securities too, and probably have a significant loss on them. I don't know if it wipes out their equity, but I guess what I'm trying to say is I don't think this is over. I think deposits are going to flow from a lot of these institutions, that we're getting by on, low cost depositors. People realize they have better alternatives. And so, these folks are going to have a hard time funding, and they're going to face one of two problems. Either they're going to lose deposits outright, and or they're going to have to, borrow at higher rates to get to it, or increase their rates to attract deposits. And so, the regional banking business just got to be a much worse business.
Yeah, and I think we're going to see a lot of bankruptcies from a lot of different companies and a lot of different sectors as the pain from all these interest rate increases the last 12 months at the pace. And the Fed still wants to hike rates more while they're doing secret bailouts off balance sheet, because there is no Fed audit, and the Fed gets away with legalized accounting fraud because the Fed doesn't have to adhere to GAAP, generally accepted accounting principles.
No, that's right. That's absolutely right. We've had, as you and I know, we've discussed this before. And as you pointed out, Wall Street on Parade does an excellent job of daylighting some of the disclosures the Fed is forced to make about the things they've done kind of, behind the scenes. I mean, I think you pointed out in the earlier conversation before that, they literally lent out trillions of dollars during the repo blow up. Now they quickly brought it back in, but the point is, they stand there ready to just print enormous amounts of money. And they will. I mean, they really have three mandates, right? They have to aim for full employment. Okay, we're close on that. They've got to maintain control of inflation. They're failing miserably on that. The third mandate that's not in the congressional, order, but we know it is one because they've said it, and because of the way they behaved, is they've got to maintain the integrity of the financial system and have functioning financial markets. And 2008 brought that into question. And what we saw is that they'll break all the rules, do whatever they have to do to keep things going. And, ultimately, I mean, just as Powell said in March of 2020, I've got the bazooka, we're going to do whatever it takes. That's coming. That will happen again if things continue to deteriorate. And I believe they will. I mean, I don't think the world economy and the debt structure that we have can exist at a 4.75 Fed funds rate, much less a 5.5, or 6. I mean, I think we're very close the breaking point, and we actually, in my opinion, we actually just saw the kickoff of the breaking point. But it could be a little while before we get to the point where they pivot and start reinstate QE and take us down to ZIRP and all that sort of stuff. I mean, I think they're going to try and avoid that as long as they can, because they've got a legitimate and serious inflation problem, and they know it.
Well,
and so they'll avoid doing that. But eventually, my opinion is, when push comes to shove, and you're at risk of the ATMs not working and a GSIB failing, they will take emergency measures, and that the emergency measures will include printing, because if they don't, the alternative is they will have widespread bankruptcies, and it'll look kind of like the Depression. And I think at the end of the day, they'll choose not to go that direction. It's not impossible they'd go that direction, though. I mean, you have to always keep it in the back of your mind as one of the possible outcomes.
Yeah, we're looking also at a lot of derivative failures that the Fed's going to have to either figure out a way to cover, or a press release just announced. I don't know if they're actually going to print the money, but they're going to say they're going to guarantee it. So the interest rate swaps with the Credit Suisse bailout. On top of that, Lawrence, you also have all the commercial real estate mortgage-backed securities that are tied to commercial real estate prices. So if commercial real estate crashes, not only will that hurt the banks and the commercial real estate investors, it will also destroy the derivatives that are attached to it that I think a lot of these pension funds bought as income products. You also have worse than junk bonds, these collateralized loan obligations, which is corporate debt with worse collateral than junk bonds, that was chopped up and sold to a lot of pension funds as income products by these Wall Street investment banks over the last 10, 15 years.
That's right. And then, the two other areas we haven't really touched upon much, but I think they only make the problem more complicated, are that we really had an economic bubble, and we really had kind of peak employment and everything else in December of 2021. And, we haven't gotten into heavy layoffs, and the unemployment rate is still relatively low. But, I mean, I'm sure a lot of people at Silicon Valley Bank are just about to lose their job. And we've seen more and more increasing layoffs. And we know that, auto loans are going bad rapidly. And so, we know that the housing market has had an enormous slowdown. So there's a lot of, people there who are now underemployed and will someday be laid off. And so, the economy is going to roll over here at some point as a result of all these financial events. And that won't help things, right? I mean, suddenly earnings will be lower, cash flows will be lower, the whole 9 yards. And so, if you had a cash flow that supported a level of debt and suddenly your cash flow gets cut in half, well, that impairs that debt. And so, as we all know, it's a circular economy. And, when somebody loses their job, they're not buying a new car, they're not buying a new house, they're not spending as much. I mean, it all.
And then tax revenues collapse too.
Yeah, exactly. It all kind of cascades down. The final piece of the puzzle that we haven't talked about much either is that the fiscal situation of the United States government is getting much worse. Okay, so you've got the Fed. I mean, Biden took great credit for reducing the deficit, and really what happened was he was lucky. In 1991, we had a roaring bull market, which led to huge tax receipts in when I say 1991, I meant 2021. In 2022, we had enormous tax receipts from capital gains and the stock market being on fire. And it basically created about $600 billion of tax receipts that were above trend. Okay, so the government is naturally kind of running a deficit of 1.4, 1.5. And that's kind of what they reported in that fiscal year. But that was because of that excess tax income. Well, that's gone because the stock market's not having a record year and the capital gains income is not coming in. So that takes the deficit up to kind of 2 billion. And then if you look at the chart, which is a wonderful chart to look at, the interest costs that the government pays. I mean, they're constantly rolling over their debt, taking on new debt. The new debt's more expensive. I mean, a couple of years ago, probably 3 years ago, the interest charge the government would pay would be maybe 300 billion a year. Now it's kind of a $700 or $800 billion run rate. So that gets added onto the deficit. Then you look at the biggest expenditure category, which is Social Security and Medicare. Well, as a result of the inflation, those two things have now gone up. I mean, the Social Security adjustment, I believe, was 8.9%. So, on a $1 trillion of social and Medicare, I don't know, add another, close to $100 billion of expense. So the point I'm trying to get at is that the U.S. government is running larger and larger deficits, which will need to be monetized, which will then lead to more inflation, and that more inflation, will push the bond market to push interest rates higher, and higher interest rates on $31 trillion of debt. That doesn't solve the problem. That makes the interest costs higher. And this is, what we've all kind of labeled, the debt doom loop. I mean, you kind of get into a trap that you just can't get out of, because, your revenues are going down, tax revenues are going down. There was a big drop in tax revenues in January of this year. Your expenses are going up because interest expense is up, inflation is driving the cost of living adjustments on Social Security up and other things. And so collectively, you get deeper and deeper in debt. And this, it's funny because this is at the sovereign debt level and it's in a first world country. Well, the only time we don't have a good example of that, ever really. But this kind of problem has been faced in third world countries many, many times. They get too much in debt. And what happens in those situations is eventually the government is faced with either, a debt haircut or restructuring, whatever, letting it all collapse, or more likely what they do is they print to cover the difference. And that's how you get Argentina. And that's how you get Weimar. That's how you get either high inflation or hyperinflation. I mean, hyperinflation is very extreme and not super likely immediately, but it is on the possibility. It is a possible outcome. The more highly likely outcome, in my opinion, is you just get really severe inflation. I mean, I think the next decade is going to look very much like the 70s. Perhaps the 70s on steroids, and we're just not going to be able to get rid of inflation because of all the monetary, kind of the way the monetary system is broken, in my view.
And Lynn Alden has also talked about either it's the 1970s or the 1940s, so post-World War II era, where the government had immense amounts of debt, and there was actually secretly a lot of inflation, a lot of bad government policies. You just didn't see it show up until the 1970s stagflation. So there was actually a lot of hidden inflation in government spending and misallocation of capital in post-World War II. So the late 40s, 50s, 60s, until finally the double-digit stagflation and the high interest rates in the 1970s. So we could be headed.
And you had a better situation there because the demographics were better. You had a whole young hero generation that just won a war and came back and decided to build houses and buy cars and buy.
The U.S. was also the only creditor nation, and we had the only factories that weren't bombed and destroyed, so we could export.
Well, and they did something which I think they're going to be forced to do this time, Jason, as I'm sure you know, is they instituted yield curve control, right? I mean, they said, okay, our debt is too high compared to GDP. We know that what that would generally mean is the interest rates would go very high, and that would really squash the economy. We're going to put in yield curve, and they kind of euthanized the bondholders. I mean, the real screwies from World War II were the people who bought war bonds, because there was enough inflation following the war that they didn't get paid back in anything close to real terms, since they capped the yields for a bunch of years at like 2.5%. And that's what's probably going to have to be done here as well. I mean, if they lose the bond market, and if the entire bond market determines, these guys are out of control, they're going to print these currencies. Currency is going to be severely debased. So people start selling bonds and buying gold or buying Bitcoin or buying real estate or even buying stocks. Then, the interest rates could go higher and higher. And then back to the debt doom loop, I mean, let's just go to an extreme. Let's say, we've got $31 trillion worth of debt. Let's say the interest rates went to 10%. It takes, and by the way, the debt average maturity is 3, 4, 5 years. So it takes a while for the new higher rates to float into the cost, because you've still got some of the old cheap debt hanging around. But let's say they did, let's say we've gone through that. I mean, can you imagine if we had $31 trillion of debt, 10% interest rate, and so we've got $3 trillion a year of interest expense? I mean,
that would be over 100% of the tax receipts, though.
Exactly. I mean, and that's before you got Social Security and Medicare and the defense budget and everything else the government does. So, I mean, it as I say, we're kind of bordering on the edge of banana republic kind of stuff. And I think what's going on right now is I think the market's kind of waking up to that. I mean, it's surprising to me it's taken so long. It's been obvious to me for a while, but I mean, I'm used to being early and wrong, because it's happened a lot to me throughout my career. So, but I do think that in general the market is kind of figuring it out, and that's why I mean, look at Bitcoin. Bitcoin was 16,000. What is it now? 6 months ago, maybe a little less. I mean,
yeah, have you noticed there's a lot of mainstream like hedge fund managers that went to like Harvard MBA, and so that maybe they have an economics degree or an MBA from a major business school, and so they're Keynesians and deflationistas, and they're saying, I'm going to short gold here. they're like the yield is too high, gold's going to crash. I just see these predictions from the mainstream finance crowd all the time now.
Yeah, I haven't actually, I don't read a lot of their stuff, and I haven't seen all of that. I don't know, but yeah, I mean, look, to my view, to my way of seeing, I do know some people. I know I haven't looked at them recently, but I know the 5x5 year inflation swaps were saying that 5 years out we're going to go back to 2.5% inflation. I just think that's dreaming. I don't think there's any way in hell, given the constellation of events we've got here, that we're going back to inflation that low anytime soon. I mean, unless we have an absolute economic depression. I mean, unless literally, the economy collapses, a la 1930. And by the way, that's not entirely out of the range of possible outcomes if they keep raising rates. In spite of the fact that they keep bailing things out behind the scenes, it's possible that they break enough things that we get a cascading downturn. I do think, though, that at some point it will become obvious to them that they have that cascading downturn. And I also think, based on the history of the institution and based on their political instincts, which is worse, complete financial collapse or inflation, they will choose inflation, hoping that it's an inflation they can live with, because complete financial collapse feels pretty awful when you're in a position of power. So that's my bet anyway. But I'm open-minded to the possibility that they aim for complete financial collapse and get it. It's not impossible.
In either scenario, if they have like a short term and they allow a lot of bankruptcies, I think the government would try to take more control over the economy. I mean, it's headed towards 50% of GDP or around there, depending upon how you measure government spending. And there's so much.
No, it's sad. And it's, and as you know, there's the risk of the CBDCs. I mean, look, one of the things I've observed in my, 40 some odd years of being a professional investor is that they will do whatever they have to do to protect their privilege. I mean, look at how they reversed the nickel trades. Look at how they banned short selling in 2008, which cost me a ton of money. I mean, it's just, they make up the rules as they go along. I mean, they got rid of Glass-Steagall. It's capitalism for the rest of us and socialism for the rich. I mean, in 2008, they bailed out all those investment banks who had feasted on, the fraud of the mortgage fraud that had been, taken place. So there's no doubt in my mind that, they're going to try again to bail out the politically connected. I mean, a perfect example of that actually is Silicon Valley Bank. I mean, Dodd-Frank said very clearly that, the next, I mean, they knew 2008 was bad. Dodd-Frank came in and they set up laws and they said, look, if we have another one of these things, they're going to be bail-ins. The people who are customers, depositors of that bank, they're going to lose money. You've only got $250,000. That was what the law said. That was the hard black letter law. But the fact of the matter is, when push came to shove, and they were looking at a Silicon Valley collapse and potential contagion and the whole economy going down, they just decided to break the law. And no, you can't do that. My sense is the guys I talked to and the analysis I did suggested that the hole at Silicon Valley was between 20 and $40 billion. It's a lot of money, but it's not JP Morgan kind of money. It's small change for an economy where you've got a $2 billion federal deficit. And they could have put that on the depositors, and there was say 200 billion, roughly, a little less, of deposits, and let's say it was 20. So the depositor would have said, if you have deposits at Silicon Valley Bank, you had $1 in there, we're giving you 90 cents back. Tough shit. You should have picked a better bank. And that's what Dodd-Frank would have said they should do, but they didn't do it.
They were panicking it would cause contagion then, because other people would start pulling their cash from other similar banks then.
Exactly. And think about it, and by the way, I mean, the lobbying that weekend had to be just intense. I mean, I'm sure every large venture capitalist, every large technology executive in California and their brother, because they were all using Silicon Valley Bank and had millions of dollars there that they were looking at getting a haircut on. I mean, you saw what Bill Ackman said on Twitter. I mean, he was crying like a baby, that the world is going to end if they don't bail this thing out. And, that kind of stuff can become self-fulfilling. And so, obviously Yellen and Powell said, all right, screw Dodd-Frank. We're going to break the law and go do that. We're going to do it this way because, our third mandate is keeping these markets working, and we're afraid they won't work if we let the natural cleansing process take place. My view is actually they would have worked fine. I mean, they could have easily given everybody who had an account there half their money back right away because they had all kinds of liquid stuff to sell. And then they could have said, you're going to get the other 40% or 30% or whatever the hell it is over the next year as we unwind this bank.
Yeah, but now, like, the people with over 250,000 in cash at these banks, I think they think that they're going to get full guarantees, but we're not having any type of real capitalism then, because they're not going to allow bank failures, or it's picking and choosing winners and losers.
Well, that's the thing. I mean, it's picking and choosing, right? I mean, if you're, look, by the way, if you're at Signature Bank, which happens to be a crypto bank, and they're trying to kill all the crypto banks with this, Operation Choke Point, and it's, I mean, by the way, I don't think that bank was in that much trouble, right? And they, no, let's let that one fail. I mean, let's shove that one off the cliff. And so
that's what Barney Frank said, right? He said that they're being targeted because they're major crypto.
Exactly. And so, okay, so I mean, it's worse than crony cap. I mean, it's worse than not following capitalism. It's crony capitalism, but the government is going to decide who's politically correct. And what are they going to decide? Oh, this bank is woke. Okay, we're going to save them. Well, this bank over here, those guys aren't very woke. We're going to let them fail. I mean, it's an incredibly dangerous precedent to be setting, and it's not rule of law at all. I mean, it's capitalism for those in control to benefit those in control, and it costs the rest of us money. I mean, one of the things that really angered me about the whole thing is that they made three statements, all of which were untrue. They said, this is not a bailout. Well, of course it was a bailout. If they hadn't done it, everything failed, right? Then they said it won't cost the taxpayer anything, which which isn't true. I can't remember the third statement, but the not costing the taxpayer anything is untrue, because in fact what it did is they were giving banks that had a 70-cent asset, they were giving them $100 or $1 for 70 cents. So they were printing 30 cents of additional money into the system at mark to market, and that's new money floating around that can be used for other things. And so that's dilution or debasement of the money supply. And so of course the taxpayers are going to pay for it. We're going to pay for it in the form of inflation. And that's really, that's the big lie of Keynesianism, that this stuff is, that what they do does not hurt people. They don't look at the follow-on effect of their action. They say, oh, this is great, we saved the financial system. That's really good. Well, yeah, look, I'm all for saving the financial system, but what's the cost? if the cost is printing a bunch of money that suddenly makes, my gasoline go to $5 or $6 or $7, well, it wasn't free, was it?
Well,
right?
there's two major problems with the financial system and why I think it's broken and why they have to paper over everything. The bailouts have to get larger since 2008. So you have fractional reserve banking in general, and then you also have the sheer size of the over-the-counter derivatives market. It should have never been allowed to get that big, but because it's that big, and if there's any type of failure, say if Credit Suisse's interest rate swap derivatives, all it takes is one bank or one hedge fund in there to not be able to pay back the counterparty, and then it just creates a domino effect of failures.
Exactly. And actually, I would add a third point to that, and that is the repeal of Glass-Steagall was enormously bad policy. I mean, the banks are regulated, backstopped by the Fed, and should not be gambling, right? They should just almost be like public utilities. Their job is to process payments and make safe loans and just be careful.
But once Glass-Steagall became repealed, though, the large banks essentially became hedge funds.
That's right. That's exactly right. And that's my point. So that, I would say, yeah, you've touched on all the points that they've basically messed up. And, the people who did that were Robert Rubin and Larry Summers and, a bunch of guys who, knew that they, if they could get this financial system if they could change the financial system into a heads we win, tails we lose system, they would make an enormous amount of money. And they have. Everybody.
Who knows how much money they got paid to lobby in DC to get those laws changed?
I'm sure it was a lot. I mean, I've heard rumors that who knows, right? This is all secondhand, thirdhand, people who know people. But I've heard, Ben Bernanke is on the board of advisors of Citadel. It's Ken Griffith, risk parity hedge fund. And, Griffith has a $250 million penthouse in New York. And, the rumor I heard is that Bernanke is getting $20 million a year to serve on that board. Right.
Wow.
Yeah. I don't know if it's true or not. It's just a rumor. But the point is, Janet Yellen got $7 million for making speeches to financial organizations. Do you really think what she has to say is worth $7 million?
Not given her track record, no. She said inflation was too low for from 2012 to 2018.
She said tapering was going to be like watching paint dry, right? She says all kinds of things that are just ridiculous, and yet she got paid $7 million for her wisdom, and really that's just a soft bribe, right? That's just these financial institutions saying, all right, let's pay this woman $250 to come give a speech because someday we may need some help from the Treasury. And or the Fed or wherever she was at the time, and if we do that, the odds are good she's going to kind of look upon us favorably, right? So they view it as a business expense, right?
Yeah, this is unfortunately part of the revolving door of corruption. So when you said 250, you meant 250,000 per dinner just to sit and eat dinner with Janet Yellen, which is what some of these hedge fund managers were paying. I think David Einhorn paid, $400,000 for a one-on-one dinner with Ben Bernanke years ago. And he said he left the dinner thinking basically that the U.S. federal government finances were hopeless and that the system was going to have to run its course.
Yeah. Einhorn's a smart guy. I know him through a friend. He's pretty impressive. Yeah, I know he gets it. Look, it's getting to be widespread. I tweeted it out today. Jeffrey Gundlach, who runs, Double Line, it's a $92 billion asset management firm out in California. He's a bond guy. Go read my tweet. It basically he said, look, it's over. The Fed has lost control. They've lost credibility. They've got one solution, which is printing money. And if you don't own gold, you're insane. I'm paraphrasing what he said, but that was
this is a bond guy with higher interest rates that he could be taking cash and buying bonds with, right?
Absolutely. So, and he probably is in this business because he has to. That's what his business is from. But the point is, the quiet stuff that, until recently, only as crackpot gold bug Bitcoiners were saying, is starting to get said out loud by people in real positions of power and influence. Gundlach is a very highly legitimate guy. He's on CNBC all the time. He's won bond manager of the year a bunch of years in a row. He's a very credible guy. And, he's kind of saying what we're saying, right? So, we're getting to the point where the fact that the system is broken, the fact that the Fed is being locked into print, the fact that they can't change their policies, these things are becoming widely known. And so, if that's a tipping point and you don't have sound money investments, look out. Because my view is when gold takes out 2063, which is, I think, the Russian high of earlier this year, early 2022, when it takes out 2063, it's going to 3,000 really quickly. And then when that happens, all the gold stocks, which are, make multiples of the move in the gold price. I mean, the rule of thumb is if gold goes up 10%, the gold stocks go up 30. And the reason for that is any gold stock is a flow of future gold, whereas the metal itself just sits there and doesn't grow. The gold stocks are just going to explode. And I think Bitcoin's going to explode too. I fully expect to see Bitcoin back at it.
These interest rates, Lawrence, with the cost of capital, do you see a lot of new mines getting built though?
No, hell no. I mean, there are a few. Only the very best projects have been built. I mean, I've got a chart that I use a lot of presentations. It talks about how we haven't been exploring and we haven't been building capacity. And the reason for that is the stuff has been suppressed by all the paper gold out there. And people say, oh, well, yeah, the problem with gold is that, price goes up and you're going to get all kinds of supply. Bullshit. I mean, it takes between 3 and 10 years to build a gold mine. Now, if we have $3,000 gold, yeah, more capital will flow into the area and more projects will get started. And, in 6 years, we'll have more gold production. There's no doubt about that. But, it doesn't we can't turn on a tap. It's not like we get more gold tomorrow.
Yeah, it's not like an oil well in the Permian Basin where in 6 weeks or a couple months, they can have some new wells back online pretty quick.
Not even close. It's a long, long process. And all the companies I've invested in have an embedded asset. I mean, I've got companies that have 1 million ounces of gold in the ground. Well, 1 million ounces of gold in the ground at $1,900 an ounce, that's $1.9 billion of gold value. Now, it's in the ground and you've got to spend CapEx and take time and money to get it out, and usually, to get them to say mine $1.9 billion worth of gold, you got to spend 800-900 million. But the point is, I've got companies that I like what I just described that have market caps of $20 million.
Yeah, the market's valuing that gold in the ground at $10 or $20 an ounce. I've seen in some cases.
Exactly. And I mean, I just bought one at $4 an ounce. So it's nuts. It's absolutely nuts. And I think people are going to be just shocked at how much upside there is in some of the stuff that we hold.
Is this why we're seeing now, Lawrence, the larger royalty and streaming companies, so the medium-sized ones are doing insane amounts of mergers and acquisitions the last 12 months, and then you're also seeing more aggressive companies like a Hecla Mining, a B2 Gold, Newmont even is making a bid, a large one for Newcrest. Agnico Eagle has been very aggressive lately. Is this why we're seeing more deals?
Absolutely. The smart management teams can see it coming, and they're thinking, let's avoid the rush and let's get things while they're still relatively cheap. The dumber management teams will come later and probably do stupid deals and overpay, like they did in 2011. But we're years away from that. I mean, there's you can throw a dart at the gold stock list, and the company's probably a good buy and probably cheap. Now, there's some that are much better buys than others, but when we get through this 2063, as I talked about, I fully expect all this stuff to very quickly double. And it'll still be cheap. I mean, I've got companies that are trading at 2-3 times cash flow. So they double, they're trading at 6 times cash flow. And that's cash flow at $1,800 an ounce. That's the other thing about the business. There's a lot of operating leverage, as you know. The average ASIC now is running about $1,100, $1,200. That's the cost to pull an ounce out of the ground. So at $1,800 an ounce, you're making $600. Well, take the price up to $2,500 or $2,400 an ounce. You just doubled your profit, right? Because I mean, the ASIC
it depends on energy costs. It depends on energy costs and labor costs, but I mean,
the ASICs are going to go up as oil costs go up for sure, but they don't go up as fast, right? I mean, they're not going to, and so, there's a lot of operating leverage here. So, you add, say you have companies where your profit might double, and that's even just with the same production. I've got companies that are growing their production, and then you get multiple expansion. I've got companies trading at 3 times cash flow. Well, in 2011, in a roaring bull market, some of these things traded at 15 times cash flow. I'm not saying that's right, but I'm saying that's what happened. So, 3 times cash flow to 15, there's a 5-bagger with no change in cash flow. Take the metal price up, and double cash flow. Well, that's a 30-bagger, right? So, I mean, the point I'm trying to make is there's some real embedded, asymmetry here that I don't think a lot of people understand. I mean, the gold stocks, if you look at the disconnect between the price of the gold stocks and the price of the metal, to me, it's absolutely stunning. And that's because historically, for the last, there was an incredible gold bear market from 2011 to 2015. It's like, tell me about it. I lived it. It was painful as hell. And everyone's looking backwards and they're afraid of that. And they're not looking forward and saying, okay, hang on a second. This is changing. And when it does, there's going to be a real roaring bull market here.
But the companies that survived that bear market, Lawrence, they're doing really well. I mean, look at Franco-Nevada. I was just looking at my Wheaton Precious Metal shares back when they were silver Wheaton, and so everyone was writing back then during the bear market. I was getting emails and phone calls from people that is silver Wheaton going to go bankrupt. I was getting these every day during the bear market, right? And I just checked my my account, and I'm up around 200% on my Wheaton Precious Metal shares, and all I did was just buy them when the shares when I thought they were cheap in 2012 or something like that at around $12-13 a share, and now they're like 45 and paying a dividend.
Exactly, and it's only going to get better. I mean, we're just getting started here. I mean, my fund from the peak of the 2020 run, with that big piece of inflation, I'm down round numbers. I'm 50 odd percent. I mean, so I gave back a lot. I mean, I was up 97, then I was up 120 2 years in a row, but now I'm down 50 from that peak. But when this next run comes, we're going to go tearing to the upside. And yeah, I mean, I think people are going to be very surprised at how much upside optionality there is. I mean, I deal with all the people in Toronto who build, all the analysts who build the models for these gold companies, and they're still building models where they're saying, well, gold's going back to $1,600. Well, I get it. I mean, if your ASIC is 1,200 and your price is 1,600, that's 400 a profit. It's not that much. And so, okay, so the stock is worth X. Well, that's not going to happen in my view. Gold's not going back to 1,600. It's going to stay at 19 or 2,000, and probably it's going to go to 3,000. And when it does, oh my God, right? The stock is going to behave incredibly well. So again, I'm pounding the table here that, you haven't missed the boat on this stuff. I mean, it's up off the bottom. The bottom was in September of last year. And, I just did a Real Vision interview where I laid out 3 stocks for them, my 3 best ideas. And I'm actually going to put that up on Twitter too. They've now told me I can put it out to the general public. They charge for the subscription, but and these were all ideas that I recommended in September of last year, and they're all up 30%. So obviously you'd have done better if you bought them, but being up 30% when you're about to go up 100 or 200, I mean, you haven't missed it. I guess is the point I'm trying to make.
Yeah, I think these mid-level, there's some small cap royalty companies like an EMX royalty. And
I love EMX. It's a great company. Yeah.
Yeah, the market's not pricing in their cash flows because they just had a new royalty come online in Turkey. So it's on a large copper and gold mine.
I know the guy who runs that company. He's a really great manager, and they've got so much embedded value in that company. I love EMX. Love it.
Well, their shareholders, they have large mining companies. So they have Newmont Mining, SSR, and then also Franco-Nevada are large shareholders. And then their partner who's running, it's geopolitical risk in Turkey, and maybe the government can change the rules a little bit, but also the mine's cash flowing now, and it's being run by one of the largest corporations in Turkey.
Yeah, and the nice thing about those royalty companies, the way they do it, you're never really dependent on some of them have one stream that's important or more important or big relative to the others, but these guys have hundreds of potential projects and streams. So, okay, so Turkey screws you, right? It's possible. I mean, that is one of the real dangers of this business, right? That, the countries screw you. It's happened a lot. Happened in Venezuela. It's kind of happening in Peru now. I wouldn't touch Ecuador. There are others that are not so great. But the point is, if you've got 15 streams and, 1 or 2 are in dangerous areas, fine. They go down. Again, they're all so asymmetric. I mean, that's why it's a very tough business. But the reason it works as an investor is that you find things that you think can go up between 2 and 10x, and you got to have 10 of them. You can't buy 1 gold stock. You can't buy 2 gold stocks, because if heaven forbid you bought the wrong one, it could not work, because it's certain that some of them will not work. But if you have 10 that all look very attractive, and 1 or 2 of them don't work, and the other 8 do to varying degrees, maybe one of them is a 10 bagger. A 10 bagger quickly makes up for the 1% you lost. If you bought 10 names, right?
Well, I think in this royalty environment, I think the small cap ones that are cheap. So if EMX continues to lag, it's going to get bought in the next 12 months.
Well, it may or may not. But one of the things I like about it, and that's one of the risks actually in all these companies, is that they get a buyout offer and they feel obligated to take it. I mean, nothing angers me more, frustrates me more than when a good company that should be a 5-bagger gets a buyout offer at a 60% premium and they sell. And then suddenly you don't have the pure play.
That happens all the time, though. I mean, unfortunately,
sadly it does, and that's why what you got to look for is you got to find a shareholder base that knows what it's worth, and so that if they get and usually what happens is the buyers won't even go after those companies because they know, hey, there's no way I'm going to get the 50% votes needed to do this deal, right? And so that's another factor that you look at when you're picking these names is who owns this thing. And are they smart? And are they willing? Would they take a stupid offer, or will they say, no, I'm not taking that?
Well,
This is a 10-bagger.
I think Mavericks Metals was sold because Pan American Silver needed the cash to fund another acquisition. So Pan American Silver was the largest shareholder in Mavericks, and from what I heard, they really needed to raise the cash. So that's why they wanted to.
That's right, and that was sold too cheap. I had a lot of them. This has happened to. I mean, Continental Gold, sold to the Chinese too cheap. Taranga sold to Endeavor too cheap. I mean, and look, I made good money on all these. I made 2-3 times my money, but I should have made 5 or 6. And that is one of the risks in the industry. But look, it's a very tough business. But if you pick the right names and you're careful and you diversify widely, if we get a tailwind here on the gold price, and that's not a big if. I think it's pretty likely, but it's certainly not a guarantee. If we get a tailwind on the gold price, if we get through this 2,000 going to 3,000, now look out. These things are going to work. I mean, they're really going to work, and you're not too late. I mean, they're up off the bottom. They're 20 or 30% off the bottom, but that to me, that indicates that the bottom is in. They've turned.
So, last question before I let you go, since we've been going for a little over an hour. Are you more optimistic then about the margins for gold miners and silver miners? Because the silver miner earnings that came out in the last month or so, a lot of them were abysmal.
Yeah, boy, they sure have been. I mean, I don't know. I mean, it's gold, silver. I mean, it's so yeah, there are better margins right now generally in the gold business, but I mean, you can have a tough time in the gold business too. I mean, look at First Majestic with Jared Canyon and how badly that blew up on them. But honestly, I view that as an opportunity. We were buying First Majestic today. The silver miners have in general thinner margins. I mean, a lot of them are, kind of an ASIC of 16 to 18, which when silver was trading at 21 or 22, didn't give you a lot of cushion. And that's a negative, right? That makes them somewhat scary. Having said that, that also gives them a lot more operating leverage. I mean, when you're only, if let's say you're selling at 20 and your ASIC's 18, you're making $2. Well, if silver goes to 30, your margin just went from $2 to $12. So your profits just went up 6x, right? So
it really depends then if you want that extra leverage, if you believe silver's going to $30, $35, $40 an ounce, because if silver lags, then those silver miners are going to be in a lot of trouble, especially like these silver miners that bought a gold mine. A lot of them, like Fortuna Gold and Silver, Pan American was even having problems with their Mexican gold mines that they bought years ago. The last 12 months, those mines have started to have big problems, and obviously
silver's been a tough bit. Silver mining has been a tough business. It really has. I mean, I have not made a lot of money in silver mining. I mean, I had something blow up on me, a stupid deal that Arcana blew up on me. Alexco got taken out by, Alexco didn't work and got bought by Heck. I think Heck was going to make it work. The silver business is a tough business, but in a bull market, silver will move faster and further than gold, and it will provide much greater margins. And the silver stocks are, silver's a turbocharged version of gold. It's much more highly volatile. And the reason for that volatility, there's a lot of gold out there, and it's really not used very much. I mean, it's used for jewelry and some electronic use, but very minor. There's a lot of gold out there, and it's really got just a monetary property to it. It's got two natures to it, right? It's a monetary metal, but it's also very important and used and necessary in electronics, solar, all the kind of cars we're building, et cetera. I mean, we have a big need for silver, and there's not a big stockpile laying around. I mean, there's a ton of gold laying around. I mean, you pay a high enough price, you'll find gold. But silver, we kind of are hand to mouth. And so when silver supplies get tight, the price of silver can really take off. I mean, we've seen a couple of times where it went, from $10 to $50. We haven't seen gold do a 5-bagger, right? But silver can. And I think this time it will too. I think we're going to go from 20 to 100, in this next bull run. And, mark my words. I mean, if we go to even 30, 40, 50, silver miners are going to throw off cash like you would not believe, right? And so, I'm heavily into silver now because it's also very volatile. I balance it with gold. I mean, and it's frankly, it's hard to find pure play silver companies anymore. I mean, they all have some gold. A lot of them have base metals too. So,
speaking to management teams at these silver miners, they had to buy gold mines over the last 5 to 7 years, or they would have went out of business already. That's
exactly right. They had to balance the risk. And that's what I've done with my portfolio too. I've balanced my risk. I mean, look, if we have a big downturn in all these metals prices, I'm going to have some of my silver miners are going to fail. I mean, I know that, whereas my gold miners probably won't. So, so silver, it's riskier, but for that risk, you get a lot more upside if we do have a bull market. So,
and the silver is needed by the industrial end user. So yeah,
absolutely.
they can manipulate the paper price down. They can keep it around the cost of production. If they move the paper price below the cost of production, I mean, the industrial end users are not going to get their silver.
Well, that's exactly right. I mean, that's exactly right. I mean, and there is some scrap that comes into the marketplace. I mean, my local coin dealer, I love going to his place because you see all the tea sets that poor old couple, they're kind of down to their last set of bucks, and they take the tea set in to be melted down, right? So there's a lot of it out there, but not the way there's a lot of gold out there. And yes, it's absolutely essential. I mean, we don't have solar, we don't have electronics, we don't have a lot of the things the world needs without a supply of silver.
Yeah, and there's definitely not enough copper or silver for this transition that the ESG people are pushing, the Davos crowd, and then people running these Western governments to transition electric vehicles. We don't have enough copper supply and silver supply at the current prices. I mean, we'd have to be looking at much higher copper prices and unbelievably higher silver prices.
Absolutely. Well, and to go a step further, because I own a few of these too, lithium. I mean, if we want to do what we're trying to do with cars and electric cars and lithium-based batteries, I mean, we need to increase our lithium capacity 10x. And there's some great lithium names. One of the ones I own that we really like is Sigma. It's just a fabulous story. It's, in my opinion, it's going to be a huge winner.
I think I saw the automotive companies are starting to buy these.
Yeah, they're buying lithium supplies. Yeah, they're backward integrating into. Well, that's for the reason we just talked about. I mean, it's going to become very tight, and you're trying to build your own car, and you need lithium batteries. If you don't have access to supply, guess what? You might be paying through the nose. So, you buy it now when it's reasonably priced, and then you've got a locked-in deposit that you can use in the future. And then, these people aren't stupid, right?
Well, I think there's a ridiculous assumption right now by a lot of these electric vehicle makers that there's plenty of copper available for them to build all these many millions of electric vehicles. But look at what happened with the warehouses, the London Metal Exchange warehouses, Trafigura, the commodities trading house, right? Over 500 million they paid for the nickel, and there's no nickel in the warehouse.
Yeah, it's rocks. Yeah, isn't that great? Yeah, no, I mean, you're right about the copper. Copper supplies are tight too, and Bristow at Burack has talked about that, and I don't like the copper business as much. Though it's a tougher, more capital intensive business. And
it's open pit. I mean, the grades on the copper and the gold for an open pit mine, it's basically you're wasting tons of electricity, tons of diesel, tons of chemicals to move 2 tons of uneconomic rock. I think it's about a 1 gram per ton gold. It might even be below that now.
It's copper mining is a tough business. So I own a few copper miners, but not, and they generally have a precious metals component to what they're doing. So yeah, it's a tougher business. But look, I mean, as Zoltan Pozner has said, I mean, this is the age of commodities, right? I mean, we underinvested in this stuff in a ZERP world with a FANG backdrop and the stock market going crazy over everything technology oriented that we kind of had post 2009. It's where all the money was made. We completely ignored investing in commodities all over the place. Maybe with the exception of shale oil, which we invested heavily in, and that actually saved our bacon because it kept our oil costs low. But in terms of basic commodities, whether it be nickel, copper, even lead, I mean, it's all of these things. We have not expanded capacity at all what we need to, when you consider that a lot of these things are essential components of an ESG world. And if you want to get an electric fleet, if you want to use electricity as opposed to, dirty carbon fuel.
Well, Lawrence, I really enjoyed our discussion today. If my listeners want to check out your work, how do they do so?
It's simple. I'm on Twitter and I make a lot of noise. Just my name, Lawrence Lepard, at Lawrence Lepard. And then I have a website, and we have published newsletters and white papers and opinions on all kinds of stuff, and it's free. And that website is EMA2, Edward Mark Alpha, the letters, 2.com. And you can go there, and you can also sign up for a free newsletter we send out. We won't spam you. Every time we write a newsletter, we send it out to the list if people want to read it. So, we just try and share and spread the word on sound money and why we think it's important. And we think it's a great investment theme in today's climate. We also think it's important in terms of what we need to do to fix kind of the broken political and financial system we got.
And people should be wary of your copycats on Twitter. I think your account has more copycats than anyone else I've ever seen.
Yeah, it's horrible. God, they've gotten all over me. But I am a blue check mark, and I have, I don't know, 120K plus followers. So if you see a copycat, just look at how many followers there are. If it's not 120, it's not me. And I will never DM you. I will never tell you ask you how your trade is going.
Yeah, you're not trying to sell people a winning crypto trading system
anything
at 2 a.m.
Yeah, no, exactly. I mean, if I follow you, make sure it's really me. I mean, I try anyone who comments intelligently on my stuff, I follow them. But you know, a lot of people get followed and then they say, "Oh yeah, I followed you," and then they started marketing to me, and I thought it was you, and it's horrible. I mean, I thought the blue check mark was going to solve this problem, but sadly, it hasn't entirely solved it.
I guess copying is the most sincerest form of flattery, and I've seen more copycats with your account than any other one.
I don't know about that. Yeah. Yeah.
Okay, well, thank you so much for your time today. I appreciate it.
Oh, thank you, Jason. It's always fun to talk to you. You clearly get it. And I love the way you're in DC and you kind of know a lot of the buzz of what's going on down there. I love our talks before and after the recording. So it's fun.
Yeah, well, I'm right outside of DC. I mean, I used to go into the city a lot more for the happy hours and the charity events and the partying. I don't drink as much. So, and then with the pandemic, I don't go out as often as I used to, though.
Yeah. Well, sometime when I'm in DC, we'll have to meet. I'd love to catch up with you. We haven't had a chance to meet face to face. So anyway, it was fun being with you. And people should feel free to reach out to me on Twitter if they have questions. I'm happy to, to the degree I can, I try to answer questions on DMs.